Good afternoon, everybody. Today is Monday, the 3rd of October, and this is Brian Shannon speaking. Let's take a look at this market here. We did see more weakness, as was kind of expected. We've been seeing the pressure build with these lower highs below the declining 50-day moving average, and this support level has been tested repeatedly. Now, we are getting a little bit extended to the downside, and this is obviously, or maybe not obviously, but this is a closing low for the year as well as a new intraday low. So we did take out that August, I think it was August 8th, was that, or August 8th or 9th, we did take out that intraday low. And by the way, it's Monday, so this video is brought to you from Realtick, realtick.com. I don't know why that was so difficult to say, but Realtick is the charts that we're looking at here, as well as the trading platform that I use. And anyways, take some time to check them out, because otherwise this is a subscriber video. So anyways, the S&P 500, we have broken below what has been the primary level of support. And as I was kind of making fun on Twitter, not really making fun, but there's a lot of calls. I mean, over here, people were calling this a double bottom. Now people are calling this a double bottom. These levels are no more a double bottom than, this day and this day being a double top, or this being a double top. People will call these things a double top all the way up, and they'll call them a double bottom all the way down. Don't listen to it. No one knows when this double bottom is going to come, if it's going to come. When we look at that weekly chart, again, we've still got a pretty scary looking picture here. We've got, we've broken some support right in here that was this prior level of resistance. The next logical level where we would kind of look for the potential support would be these lows in here, kind of in this general area near about 105. So about 105 to 106 looks like support. And we've also been talking about these Fibonacci levels. And, again, you don't want to take these levels so darn literally. Instead, you want to look at them as a guideline of where this market has potential to go. And if we make it down through that 105-ish level, well, then I think the 50% retracement makes a lot of sense. It had been a prior level of support, and it's where this market could bleed off to. And again, if we took a look at that measured move that we were talking about, I'm not going to measure it again, but it brings us down to about 98. So there's still technically some things that point to pretty 5 to 10% lower basically from here. It doesn't mean that's what we have to get locked in and believe that that's what's going to happen, because obviously there's massive volatility. We've been talking about guilty till proven innocent as it's below a declining 50-day moving average, but there's been some massive rallies in here, and these rallies have come real quick. If you're short at the wrong time, they can rip your face off. Take a look at the 30-minute time frame. We've got a mess, a downtrending mess, but we've had, tomorrow maybe we're going to see a little bit of a flush out, and then a little bit more, a little bit of a snapback rally before we continue lower. A lot of times when we see the breakdowns occur after we've already seen 4 or 5 days of downside, and we undercut a significant low that a lot of people are watching, then we'll get kind of the puke the next day, and then for lack of better terms, but people use that as a level to say, hey, I'm going to stay long as it remains above that August low. It gets below there, and then they look for the end of the world. We probably get some bad news, and that's when you look at it and say, where have we come from, and where do we have the potential to go? You don't necessarily believe that there's going to be a turnaround, but a move from 119.5 down to 110, we've seen a pretty good percentage drop here without any meaningful bounce. And today's action was pretty wild, actually. If we take a look at just to frame it here, we had the gap lower, and then the market rallied right up to the pivot level, and close to the declining 2-day volume weighted average price. But if you put that rally into perspective, that was actually a hell of a rally there. Very quickly from 112 right up to 114, just below 114 in that daily pivot level. So nearly a 2%, 1.5% rally in the course of about 30 minutes, which slowly faded, and then we fell apart. So even though it seemed obvious that the market would continue lower, there was the opportunity to get hurt on the short side in there. And so don't look at this, don't just look at the end of the day, but how did we get there does matter. If you were short, right in here, for instance, as the market made a lower low, if you didn't cover quickly, that could have been a painful loss. But anyways, we're getting to the point where we're seeing a pickup in volume, and that means there's more emotion in this market right now. The emotion isn't as strong as the last time we were down here, and hence the volume is reflecting that. But it says that the volume's getting a little bit heavier, the emotion's a little bit heavier. We have to be alert for the potential of a turnaround here for at least a snapback rally. I wouldn't be looking for a double bottom. I think it's foolish to call it that, but maybe we're going to get a little bit of a bounce back and a few days of stabilization. But right now, that's for the most aggressive traders. We're in a downtrend on the 10-minute time frame with these lower highs and lower lows. The daily time frame is in a downtrend, and the weekly is in a confirmed downtrend with this lower low here as well. So if you're going to try to trade for a bounce, be very nimble. The Nasdaq has been catching up on the downside. It's it was down 2.5% today, but this market had been, obviously, we know, the strongest really, and pretty resilient, but we're starting to lose ground from some of the market leaders, and that's getting reflected in here. We're back below that 54 level, and we're back below these lows that we were talking about over the weekend. That you look at this, where the trend is lower. That's all you can do is look at it and say, what's the near-term trend? Lower highs and lower lows. It's been a pretty steady downtrend realistically, again with some violent snapbacks. Look at that 10-minute candle here. We'll try to see if it looks as significant on the 5, but on that 1-minute time frame right here today, we had a move from 51.80 to 52.80, a dollar. Again, almost a 2% intraday rally that just didn't last very long. It was maybe an hour later it was completely gone, and we ended up right on the lows in here in the Nasdaq. And it seems as though the Nasdaq ought to continue down to at least I think 50, and test that $50 level. Until we do that, then I don't think you can really trust any rally attempts. But even there, I don't think you would trust it. It's just that we might get it's only another 2% down from here, so that seems within the realm of possibility for tomorrow, especially when you look at the way that the Russell 2000 is behaving. The Russell 2000 has been leading this market lower with that same pattern of lower highs and lower lows. It closed right at the low end of this range, and we had noted that the significance of this level, and that we would possibly be, we've been talking about the 60 level since it was 66 just a couple days ago, and talking about the possibility of another 10% down, and here we are at 61. So this market, the Russell is losing ground much quickly than the other markets. We're right down to that 50% retracement, and that's again just a guideline. It doesn't mean stick your bid in because we're at a retracement level. That's this is just, hey, here's a potential area. What else do we have that lines up in here? Well, we have these lows that maybe we bleed it lower down towards the 59 level, where this market found support on a few occasions in 2010, and then we get a little bit of a bounce, but still it would be a bounce within a downtrend, and perhaps up to maybe 64 as this prior support. 64 to 66 has been the prior support range in here. This has been the range of support for this market over the last couple of months. So this bigger range of prior support, if we bounce, could get back into that area and then act as resistance. But the trend's lower. It's guilty till proven innocent. That's what you have to remind yourself. Semiconductors were down 2.6%. They look like they're headed for at least a test of the 27 level, and we're basically there. And 27 and a quarter base is pretty much these lows. The semiconductors, you look at them. Let's take a look at this level on a bigger area. If we break that, then maybe these little highs from 2009 would be an area, or we could throw some Fibonacci on this this as well. That is the financials, and 50% retracement gets us down to 2640. Again, seems very reasonable that it could do that. The financials, as we know, they've when we look at the weekly time frame, we've been talking about this group maybe heading down towards $10.50 a share. We're beyond the 50% retracement level, and this is the 10.5 level that we've been talking about. 1080 actually. I'm sorry. 1080 is these lows from 2009 that kind of seem like the market is headed down towards that level. We've exceeded again the 50% retracement, and if that if this 1080 level doesn't hold, then you've still got maybe 61.8 that comes in. It was prior resistance at the $10.20 level. So the market remains a mess if you're bullish, if you want to be bullish. Otherwise, it is in a downtrend with lower highs and lower lows. We chipped away at support. We had that move up through there. Now the emotional move back down lower in all these markets. So if you're looking to be long, it just doesn't make sense. Still, we're in a downtrend.